Welcome to Question the Manager. Today I am joined by Ian Barris and James de Bunsen, fund managers for the Henderson Alternative Strategies Trust. Ian and James, thank you for joining me. First of all, what are your thoughts on the macroeconomic landscape? Should we prepare for inflation, or is a bear market around the corner?
Well, I think we are at a bit of a turning point in terms of the macroeconomic backdrop. Global growth is strong, undeniably strong, and I think we've got every single country in the OECD is actually forecast to have positive growth this year, which is the first time that's happened since about 2007. So things are looking positive on that front, but at the same time, clearly we're getting into a monetary policy tightening cycle. Interest rates are going up, quantitative easing is being wound down, and it remains to be seen how much of a headwind that is for markets. And the key determinant of that will be inflation. It looks like wage pressures are building in the jobs market, and if that really comes through, then we should expect to see generalised inflation start to increase, and that might mean that central bankers have to increase interest rates more than the market's currently priced in. So the thing for us at the moment, what we're looking at is valuations in terms of mainstream equity markets and mainstream fixed income markets, and they look pretty high. And if interest rates do go up quicker than expected, we think that can mean that both fixed income and equities fall. So we really think it's a good time to be looking at alternatives. The sorts of strategies that we look at can still make positive returns in a more difficult environment like that. So we think that the Henderson Alternative Strategies Trust is a good place to be in this sort of interesting turning point in the market.
The portfolio invests in 5 fund categories. How is it divided by these in terms of weighting? And has there been any material change in the past 6 to 18 months?
I think it's fair to say the portfolio has been really quite stable for a couple of years now, in the sense that we haven't made major changes in allocation between our 5 investment categories. Perhaps I could take them one by one. In terms of the largest allocation at the moment, it's to the specialist sector investment category. And that's really a broad-ranging category for us. And we put funds into that particular category which focus on a particular sector or activity. So examples would be perhaps investment in financials or biotech or renewable energy, for example. That's around 30% of total portfolio value at the moment. It's a very important source of diversification for us, given its breadth of funds that we can cover in that category. Closely behind that in terms of percentage allocation is private equity at the moment, probably just below 30. We have some very good listed private equity investments, the like of Harbourvest, Standard Life Private Equity, Princess, who have done very, very well for us, and we have taken some profits and taken top slice some of those funds over the last few months because they've done so well. But we also, in our private equity bucket, have some what we would call more idiosyncratic investments. So we have, for example, some unlisted funds that invest in very niche private equity strategies, which are very interesting and provides our shareholders with something very different. Then third in the pecking order in terms of allocation is the hedge sleeve, where we're at about 24% of total portfolio value, and there we have a number of long-short hedge funds and also a merger arbitrage fund as well. And these funds are performing well at the moment, and we expect them to provide not just decent performance in up markets, but also, especially given that a number of the funds are long-short in nature, then the shorting ability of those funds should also give us some protection when markets fall. Then we have our specialist geography bucket, which is about 10% of portfolio value at the moment. These are funds which focus on specific geographies, and predominantly that means that we're investing in emerging market funds through that particular investment sleeve. And finally, we've got our property sleeve, which is below 10% of portfolio value at the moment. We have a couple of main investments there, our Cuban property fund, SIBA, which has performed very well over the years, and also a German property fund called Summit Germany, which has done well since we bought it about 18 months ago. So overall, very well spread, diversified investments across investment categories that are designed to give us large breadth of choice and lots of diversification. But on the other side, we keep focused, we make sure that we stay within certain investment limits in each of those categories to maintain the appropriate degree of diversification between different asset classes.
And lastly, the Trust was recently approved to continue trading by shareholders for a further 3 years. What targets have you set in place before the next shareholder vote in 2021?
Well, we were delighted to get the support of our shareholders for the continuation of the fund for another 3 years. I think one of the areas that we'd like to see continued improvement on is the narrowing of the discount to net asset value of the Trust. Over the last couple of years, the average discount has been coming down. It was around 19% in the year ending September 2016, and that came down to about 15% in the financial year ending September 2017. We'd like to see that average discount continue to come down for the benefit of shareholders, so that it is a lower level again in the current financial year. How are we going to achieve that? Well, so much of this is driven by continued NAV performance. The improved performance of the Trust needs to continue to attract new shareholders and existing shareholders to buy more stock to help narrow the discount, increase demand for the shares. And that's really what we're probably putting as our main priority over the next few years, is to keep improving on that discount and net asset value. And there's going to be a lot of effort put in to marketing to shareholders as well, to make sure we get extra interest in the stock for the Trust.